The 24-month pattern. What the wealthy do before everyone else knows something is wrong. Zurich, Switzerland, March 2006. A portfolio manager at a private bank makes a phone call to his top 20 clients. He tells them to liquidate their equity positions. Not gradually, not when there's a pullback. Immediately. Move 60% into short-term treasury bills. The clients push back. The S&P 500 is at all-time highs. The economy is growing at 3.2%. Unemployment is at historic lows. The housing market is booming. He loses 3 clients that week. They fire him for being too conservative. 18 months later, the subprime mortgage market begins to crack. 24 months after his call, Lehman Brothers collapses. The S&P 500 loses 57% of its value. Those clients who stayed saw their portfolios cut in half. The clients who made the call didn't just preserve their wealth. They had dry powder when assets were trading at fire sale prices. This wasn't insider information. This wasn't luck. This was pattern recognition. Every major economic collapse in the last 100 years has been preceded by the same signal, the same behavioral shift among ultra-high net worth individuals, the same 24-month window between the first institutional moves and the public panic. And the forensic data from 2024 and 2025 shows that window is open right now. Part 1. The liquidity signal. Here's what nobody tells you about wealth preservation during crises. The wealthy don't react to crashes. They position before them, and their positioning leaves a forensic trail that is visible if you know where to look. In 2005, the Knight Frank Wealth Report documented something unusual. Ultra-high net worth individuals globally had increased their cash and cash equivalents from 8% to 23% of total portfolios. At the time, financial advisors called it missing the rally, said they were being too conservative. They weren't missing anything. They were loading ammunition. The same pattern appeared in 1998, 2 years before the dot-com bubble burst. In 2018, 18 months before the COVID crash. And most recently, in 2022 to 2023. Warren Buffett's Berkshire Hathaway held over $130 billion in treasury bills and cash equivalents by mid-2023. The financial press called it lost opportunity, said the old man had lost his edge. What he was doing was following a 100-year-old playbook. The mechanism is brutal and simple. Crashes require sellers. Sellers require buyers. Buyers require cash. The ultra-wealthy accumulate the one instrument that cannot be destroyed by the event they're anticipating. Then they wait with the specific patience of someone who already knows the script. During the 2008 to 2009 crash, S&P 500 companies lost roughly 57% of their value at the trough. If you held $10 million in T-bills earning 2%, you earned $200,000 while everyone else lost half of everything. But more importantly, you had $10 million in a market where extraordinary businesses were selling for half price. This is the first truth that separates ultra-high net worth behavior from conventional financial wisdom. The wealthy don't treat cash as something that costs them yield. They treat it as the only asset that converts into every other asset at the exact moment when those assets are bleeding out. Part 2. The distressed debt mechanism. Now we get to the asset class that transfers the most wealth during every crisis, and it's almost entirely inaccessible to retail investors due to regulatory barriers: distressed debt. When a company approaches bankruptcy, its publicly traded bonds crater. A bond issued at 100 cents on the dollar might trade at 15 cents, 20 cents, sometimes less. The market, panicking and illiquid, prices these instruments for complete loss. This is precisely when sophisticated capital arrives. Howard Marks at Oaktree Capital built one of the largest alternative asset management firms in history, almost entirely on this thesis. His October 2008 memo to clients, written as markets were in freefall, is now studied in graduate finance programs. His core argument: distressed debt is not a gamble on whether a company survives. It is a legal mechanism for taking ownership of a company's assets at a fraction of their replacement cost. Here's how the machinery works. When a company enters bankruptcy, there's a waterfall of creditors. Senior secured debt holders sit at the top. Junior bond holders below them. Equity holders, ordinary shareholders, occupy the bottom rung, and typically receive nothing. The bankruptcy court restructures the company. Old equity is wiped out entirely. The bondholders who purchased distressed debt at 15 cents on the dollar receive new equity shares in the reorganized entity. They didn't buy stock, they bought debt. They emerged as the new owners. During the 2008 to 2009 crisis, this mechanism played out at scale. General Growth Properties, at the time the second largest mall operator in the United States, filed for bankruptcy in April 2009. Its debt traded for pennies. Brookfield Asset Management accumulated significant positions in that distressed paper. When GGP emerged from bankruptcy in November 2010, Brookfield held a controlling equity stake in a company managing over 200 shopping malls worth billions of dollars. The total cost of entry? Distressed bonds purchased at a fraction of face value. The Capgemini World Wealth Report from 2010 documented that all high net worth individuals who maintained allocation to distressed debt strategies during the 2008 crisis outperformed standard diversified portfolios by 23% on average over the subsequent 3 years. Not because they were intellectually superior, because they had access to an instrument that retail investors are structurally excluded from. Part 3. The Productive Land Playbook. The third asset is the oldest one. Older than stock markets, older than bonds, older than central banking, productive agricultural land. The Knight Frank Farmland Index has tracked this asset class for over a decade. Between 2000 and 2020, prime farmland in the United States appreciated by over 500%. It didn't crater during the dot-com collapse. It didn't buckle during the 2008 financial crisis. During the 2020 COVID shock, when REITs lost 40% and commercial real estate entered a multi-year reckoning, farmland gained 7%. The reason is not complicated. Land that produces food has a floor built into its value that no other asset class possesses. That floor is called caloric necessity. Human beings require calories to sustain biological function. Regardless of whether a central bank has mispriced risk or a leveraged financial institution has become insolvent. In 2023, reporting by the Land Report confirmed that Bill Gates had accumulated approximately 270,000 acres of American farmland across at least 18 states, making him the largest private farmland owner in the country. Mainstream media frame this as an eccentric billionaire hobby. The financial logic, however, is neither eccentric nor conspiratorial. It is ancient. In the Roman agricultural economy of the 1st century BC, the patrician class systematically accumulated public land during periods of debt crisis. As small farmers defaulted on obligations they couldn't service, the massive estates owned by the senatorial class expanded across the Italian peninsula. The same pattern appeared in the post-Black Death Europe, where survivors with liquidity purchased abandoned farms from the estates of the dead at fractions of their former value. In post-WWI Germany, as the mark hyperinflated into worthlessness, foreign speculators and domestic industrialists holding hard currency purchased farmland from middle-class families who could no longer pay mortgages in real terms. Identical mechanism, different centuries. Land that feeds people retains its value when the paper used to measure that value disintegrates. Part 4. The warning signals. So, what should you actually be watching? Not the headlines, not the financial media, not the predictions of economists who missed every major crisis for the last 30 years. Watch the behavior of people whose entire professional lives are organized around this single recurring event. First, the yield curve. Specifically, the spread between the 2-year and 10-year Treasury. When it inverts and stays inverted for more than 3 months, start your clock. The 2022 to 2023 inversion lasted 14 months, the longest since 1981. Second, Berkshire Hathaway's cash position. Buffett doesn't move billions without a reason. When his cash exceeds 20% of the portfolio, pay attention. It hit 25% in Q3 2024. Third, the Knight Frank Wealth Report. It tracks liquidity preference among ultra-high net worth individuals. When that number spikes above 20%, the countdown has begun. These aren't predictions, they're pattern recognition. And the pattern has repeated, without exception, for over a century. Conclusion. Here's what you actually absorbed in this video. Every economic crash in modern history has not been a random natural disaster. It has been a predictable cyclical redistribution event. Capital flows from the unprepared to the prepared, from the panicked to the patient, from the passive holder to the structurally positioned acquirer. The middle class was taught that crashes are things that happen to them. The data from SEC filings, Knight Frank reports, Capgemini studies, and a century of private acquisition records tells a different story. Crashes are scheduled shopping events for people who know what they're buying, why they're buying it, and what price they're willing to pay. The financial system never hid this through malice. It obscured it through the assumption that this information is only actionable for people already holding access to these vehicles. That assumption is false. The principles are not vehicle-specific. Cash is ammunition. Distressed debt is an ownership mechanism in disguise. Agricultural land is a caloric claim on the future.